Okay, let's talk about what's going on because we are in a really strange financial moment. On one hand, the stock market is hitting record after record. But on the other, it just feels incredibly risky for a lot of people, right? It's kind of like there's a huge party happening right on the edge of a cliff. So in this explainer, we're going to try to untangle these confusing signals and figure out what's really driving the market.
And I mean, first off, just look at the numbers. They look incredible. The S&P 500, the Dow Jones, the Nasdaq Composite, these are the big ones, the benchmarks for the whole US market, and they've all been hitting new all-time highs. The Nasdaq, which is full of tech stocks, just finished its longest winning streak in almost 20 years. I mean, on paper, things could not look better.
So, this brings us to the big question, the central puzzle we're trying to solve. If everything is going so well, why does it feel so unsettled? With the market smashing these records, why is there this feeling of risk just under the surface? It really does feel like we're walking on a tightrope, and we're going to figure out why.
To really get that feeling, we've got to start by looking at the view from the top. You know, there are some very real, very solid reasons the market's been doing so well. So let's break down the case for all this optimism.
So, a few key things are really fueling this rally. There's some geopolitical hope coming from peace talks in the Middle East. You've got that historic run from the Nasdaq we just mentioned. And maybe most importantly, corporate earnings are looking strong. Companies are delivering and they're hitting predictions for some really solid growth. These are some powerful tailwinds just pushing the market higher and higher. But now we have to flip the coin. Because underneath all of that good news, some really strange cracks are starting to appear. And this is where the whole story starts to get unpredictable.
Okay, take a look at Charles Schwab. They report a massive 30% jump in quarterly profits. That's fantastic news, right? You'd think so. But the market's reaction, it sent the stock plunging over 7%, making it the biggest loser in the S&P 500 that day. When absolutely amazing news gets a terrible reaction, well, that tells you the market is seriously on edge. Or what about this story? It's even wilder. The shoemaker Allbirds suddenly announces it's pivoting to AI, and its stock explodes, jumping nearly 7 times its value in a single day. The very next day, it loses more than a third of its value. Now, this isn't rational investing. This is a sign of some extreme volatility, just pure hype bubbling right below the surface. And, this nervousness isn't just contained to individual stocks. Even with those peace talks we mentioned, oil prices are creeping back up toward $100 a barrel. And that just adds a whole other layer of economic risk to everything, threatening supply chains, inflation, you name it. Jim Masterzo from Research Affiliates, I think he summed up the mood perfectly. He warns that the market has gone from cautious optimism to optimism squared. Basically, it may have gotten way ahead of itself. He's arguing it's a time to be prepared, to have some dry powder, cash on the sidelines, ready for whatever comes next.
So, what are you supposed to do with all these confusing signals? Good news is bad news is sometimes good? This is what brings us to the real story here. Maybe the key isn't trying to understand the market, but trying to understand ourselves as investors.
Now, to get this, we need to understand a concept called dollar-weighted returns. I know, it sounds super technical, but the idea is actually pretty simple. Instead of just showing a fund's growth on a chart, it measures the wealth investors actually created. How? By tracking the timing of when they bought and when they sold. And this reveals a critical truth. Timing is everything. The story of the legendary fund manager Bill Miller just illustrates this perfectly. As you can see here, from 1991 to 2005, he beat the S&P 500 for an unbelievable 15 years in a row. He was a superstar. But look at when the investors actually show up. Most of them only discovered him near the end of that historic run. They piled in right at the peak, just in time for an epic slump that saw his main fund crater from $21 billion down to under $3 billion. Now, just look at this number for a second. Negative $7 billion. That is a staggering amount of lost wealth. So where in the world does a number like that even come from? Well, that number comes from a much more recent and very famous example. Morningstar calculated that over the past decade, Cathie Wood's hugely popular ARK Innovation Fund actually lost its investors a collective $7 billion. So how is that even possible? It's simple, really. The vast majority of the money flooded into the fund after its spectacular gains in 2020, right before the fund's sharp decline. This table, this really brings the whole idea of the performance gap to life. I mean, look at Peter Lynch, a legendary 29% annualized return on paper. But he himself admitted that his average investor did way worse because they were always chasing performance, buying and selling at the wrong times. It is the exact same pattern we see with Miller and with Wood. The paper return of a fund and the actual return for the average person can be two completely different stories. So, if even chasing the geniuses of the investing world can lead to disaster, what's the solution? How are we supposed to navigate this anxious market? Well, the answer brings us to our final and honestly most important takeaway. And here it is. This is the core takeaway from this entire thing. Finding a great fund or a great stock, that's only half the battle. To really succeed, you have to be a pretty good investor too. And you know what? That has almost nothing to do with being a genius and everything to do with your own behavior. So what does being a good investor actually mean? Well, first off, stop chasing the hype. By the time a stock or a fund is all over the news, you're often way too late to the party. Second, you have to know yourself. Your own emotions, the panic you feel during a crash, the greed you feel during a rally, that's your single biggest risk. And third, be consistent. A disciplined strategy will always beat undisciplined genius in the long run. And that brings us right back to the beginning. The reason the market feels so risky, even when it's hitting all-time highs, is because it's tempting us to make bad decisions. It tempts us to get greedy, to chase performance, or to panic and sell at the worst possible time. The real solution isn't trying to predict what the market will do next. It's about controlling how you react to it. So we'll leave you with this final thought. Every single day, the market is asking you a question. And the ultimate challenge isn't to guess the market's answer, but to be truly confident that your strategy is the right answer for you.